What's going on, everybody? Welcome back to another video. In today's video, we're going to be talking about an also awful topic, a potential recession. Is a recession coming? What should you be doing in case there is a recession? How should you be handling your investments? Should you be investing in stocks, gold, oil, crypto? Where is the money safe? I mean, everybody, since we heard inflation is high, we decided to take our money from our bank account. We don't want to lose 7 to 9% inflation, so let's invest in the stock market. And then the stock market has been coming down, crashing on us. So at least we're not losing 8% inflation, but we're probably losing around 30-40% if we went long on some of these stocks. So where is your money safe? Let's talk about it. Before we get into the video, remember to leave a like, subscribe down below, and let me know what you're going to talk about next. Remember that your support always motivates me to make out more content. So let's talk about what is the Fed doing. Yet again, increase interest rates, the highest interest rate hikes we've seen since 2008. That's of course bad news for stock market. We've been seeing the stock market tumbling, but does the interest rates really mean that makes the stock market go down? It doesn't essentially mean that. There's been many times through history that interest rates have gone higher, but the stock market has continued pushing higher. So what has happened? Why are we stumbling across pretty much all markets as interest rates go higher? The main reason is that because there is fears over a recession glooming in the very short-term future. Is that going to be happening? Potentially. I definitely think we'd have a recession on our way very, very soon, within the next 12 months. Now, does that mean that we should just sell everything and we're all screwed? Well, no, everything is part of a cycle. The financial cycle is 6 stages that always leads into a recession, into recovery, into an expansion eventually. So it's okay. It's just part of the financial cycle. So there's nothing much we can do about it. We have to rebuild based off of it. We were supposed to get a recession in 2020. The Feds have decided to print our money and get us out of that recession in 2020. So now we just delayed it to 2022. The main thing that we have to keep in mind is inflation, right? The Feds, unlike what you think, the Fed's job is not to just pump the stock market so you can post your gains on Reddit, on Instagram, and flex on your friends. It's not what their job is supposed to be. Their job is to make sure that the economy continues in a very healthy and natural trend up. And if inflation is hitting all-time highs levels that we've not seen since the 80s, that means they have to do something about it, get a real tight monetary system policy that's going to bring down that inflation. We might see something that we've not seen in over 50 years since the 80s. If we go back to the 80s, we had the Volcker shock. The Volcker shock was a 80s version of Jerome Powell, Fed chairman that was brought in the mid-80s when the gold standard, the dollar was taking on the gold standard. Inflation was hitting all-time highs at the time. Inflation was skyrocketing and didn't know what to do. They decided to raise interest rates. They decided to tighten the monetary policy and do anything they could to bring down the interest rates or the inflation. Now, they were able to bring down inflation to around the 4 to 2% mark, but what did that lead to? That led to recession, high unemployment rates, a whole lot of debt for people. So that led to a recession, but they were willing to take the risk of recession to lower inflation. So you can have both things. They want a market, and J. Powell wants to talk about it, quote unquote, soft landing, which means raising interest rates and slowing the inflation in a very mild and soft manner so that it doesn't lead to a recession. But the Feds have a really, really terrible track record that shows they're not good at doing soft landings. What we call a hard landing is when they raise it too fast, too high, which crashes the market, causes a recession, raises high unemployment rates, and kind of just screws everybody over for a couple of years. That's their track record. So if I were to bet, I bet on probably recession coming very, very soon, and that's what I will be doing. Now, there's 3 ways you can go about a recession, really, if you're investing in stock markets. Way number 1 is to keep dollar cost averaging. If you're a long-term investor, you don't care if it's a recession. We're at the top of the market. We're in the middle of the market. You just don't care. You keep dollar cost averaging. You keep going about your day. You don't even check your portfolio for another 10 to 20 years. And you don't even know there was ever a recession in 2022. Well, maybe you might see the prices of things like the loaf of bread almost costing $50, $60 if they don't take care of this inflation. And you see why now they got to take care of inflation. They can't push the market up and cause inflation to be so high that it ruins people's everyday life. So that's your first option. Dollar cost average, and don't even look at the news. That's your best thing. Don't look at the news. But more than likely, if you're on this channel, you're looking for a more effective way to invest in stock market. and kind of handling your investments. I'll be explaining to you guys what I'm doing with my investment. First and foremost, I've sold a lot of my long-term positions. I've been saying that since early January. I was selling all my long-term positions, which have had tremendous gains, and I'm going to actively slowly start buying once we hit the 4,000 levels on the S&Px and 400 levels on the SPY. Once we hit 400 and below, I start again to dollar cost averaging. Until then, I don't see a point. Now, just because a lot of stocks are going down, there are certain stocks that do perform quite well when you have high interest rates. That being energy. The energy sector is actually one of the only sectors that's still up on the year. You have financials. Financials have taken a huge beating for many other reasons, and mostly being their earnings report have been pretty bad. And the reason why they've been bad because interest rates were so low. But now if we're saying interest rates are going to go higher, a lot of these financial sectors in the coming, they just had reported earnings not too long ago, but in the future earnings should report great earnings because now interest rates have gone higher, and they've done much better. And another thing that is to keep in mind that 7 weeks in a row, 7-week mortgage rates have gone higher. Now we're sitting in the mid 5%. 7 weeks straight of mortgage rates went higher. Who's pocketing the extra money? It's the financial sectors. It's going to be the JP Morgan World, Bank of America, Wells Fargo, all those huge lenders. Another thing to keep in mind is that just because these rates have gone higher, you're like, okay, finally the rates gotten higher. That must mean that the housing market is going to come down, right? It must mean that I finally afford a home and I have to pay $200,000 over sticker price, all cash just to afford a home. So true, the home prices have gone higher because interest rates aren't the only factor in the stock market, in the housing market. Another huge factor in the housing market is that people that finally they got the home for a really nice all-time low rate. Now they're telling themselves, why am I going to sell my home and have to take out a different mortgage somewhere else and have high interest rates? So now it's going to decrease the supply. The supply is really low. The demand is still high. Even if the demand has come down a little, the supply is just gone only lower. So then you see that how a recession is slowly built. They're giving all these people low interest rates. Now they want to hold on to the low interest rates. They don't want to get rid of anything. People aren't able to afford anything, and interest rates are even higher. So you already couldn't afford anything. It was already a competitive market. Now interest rates are even higher. You have nowhere else to spend your money because if you don't spend your money, inflation is going to eat it. And if you do start investing in the stock market is going down. You're not a financial advisor. You don't know where you should be investing in it. Then what are you stuck with? Investing in a potential business? Well, even that's not going good. The first time for the first quarter in a while, the GDP came negative since COVID. GDP came negative for the first quarter. Now, if you have 2 quarters, so this first quarter came out in May, second quarter is going to be coming out, and if you have 2 quarters of negative GDP, which means the economy has gone in minus, not increased, it's decreased, you have an official recession. Currently, we have only one, so we could see if the next one is positive, and then we push the can down the road. Eventually, we'll get a recession. But 70% of the GDP is consumer spending. So me and you going out to the store, buying us a nice Diet Coke to drink. If now we can't afford it as much because things have gone up too high due to inflation, interest rates are higher, we're making less money because you can spend less because you can't buy as much. That means that people are spending less, GDP goes lower. We can't afford. I used to be able to drink 10 Diet Cokes a week, only cost me $5. Now it costs me $10 for the same 10 Diet Cokes. So now we have a big issue. I can't drink my Diet Coke. I'm going to be mad. I can't spend as much money. So I'm getting less now. And the whole GDP goes down. But now, does that mean everything's gloom and doom? We had the Bank of England report that a recession is almost guaranteed coming to Europe. Now, China is already in a recession. Personally, I think it is. Now, if Europe is going into a recession, what's left for America? It's most likely going to be heading to recession. We might be the last to it, but we're probably most likely going to be leading in that way. Now, personally, what I'm going to be doing, or what I've been doing, is all my growth stocks, which I've been telling you guys to do this. You can go back to early January. I was talking to you guys about this. I've been putting in the gold, in oil, energy, diversified, and I still think that plan is going to be into a recession. The number one thing I think you should be doing is what you do every other day. It is to go out there, be an entrepreneur, even if you're not, go out there and prove that you're a valuable member to the society. Try to make as much money as possible in different businesses. Diversify. Just because your stock portfolio is down, understand it's only in the short term. In the long term, most likely, as long as you have a nice, very diversified stock portfolio, it will be coming back alive. Same thing with your crypto. I still believe crypto is higher highs to see, so don't get fooled by the short-term vision. Stay focused, and just keep going out there, keep making money, keep making bank, and I promise you, just as much as you were making money before a recession, you'll be making money during a recession and after a recession, as long as your goals are there. And as always, I'll see you guys in the next video. Peace.